Hello everyone, today I want to share my view on Luckin Coffee based on Q2 2023 figures. Yes, I know, Luckin Coffee, big fraud scandal, provisional liquidation, delisting from Nasdaq, and so on. But as of today, Luckin is a fast-growing, profitable company, much stronger than in its best days while listed on Nasdaq. Yearly sales before the scandal were 434 million, while last year they made sales of close to $2 billion. They had a loss of 460 million in 2019, while they made break even and 167 million of profit in 2022. The number of stores before the fraud was 4,500, and by end of last year they almost doubled to 8,200 stores. So they deserve some attention as a successful, fast-growing company in a booming market. I'll go through their 2023 Q2 figures today and explain some key metrics I used to analyze their development. This is purely to share my process of analysis. I'm not recommending any specific investment, and you always have to do your own research before making any decision. Now let's jump into it. I copy the information from all quarterly reports into my Excel sheet so I can easily track the development over the time. I do the analysis in local currency to avoid any distortion from exchange rate, so the figures are in Chinese yuan, not US dollar. From this, I look at the following things: sales growth, store number, sales per store, profit per store, overhead cost development, profit margin development, profit per share, and cash flow per share. These are the figures I'm using for Luckin. For different stocks and different businesses, I might take a different set of metrics. So let's start with sales. Sales growth is one main factor for higher absolute profits and share price in the future, so it's worth looking at it. The overall sales growth is quite impressive. In 2022, sales grew by 67% compared to the previous year. And in the first quarter of this year, sales grew by 20% and in the second quarter by 40% compared to the previous quarters. That means a yearly growth rate of more than 50% can easily be expected for this year. But sales growth alone can be misleading. We need to make sure the sales growth is coming from high quality sales. That's why I split it into number of stores growth and sales per store growth. This way I can make sure that they don't just open unprofitable stores to drive up the top line and number of stores. As we can see, the number of stores is growing at a fast pace. Faster than last year if we look at the quarterly growth rates. We had last year a growth rate of 25% compared to previous year, but in the first quarter alone 12% to previous quarter and 14% quarter 2 compared to quarter 1. In quarter 2 alone, almost 900 self-operated stores were opened. What is at least equally important is the sales per store. Also here we have a clearly increasing tendency. We had in last year a monthly sales of 165,000 Chinese yuan per month per store, while in the first quarter of 2023 we already had 205,000 Chinese yuan per month per store, and in the second quarter 219,000. That means they are both expanding stores while also improving the sales of each store. This looks like high quality, sustainable growth to me. So what about profitability? I split this into two blocks. First block is the contribution margin coming from running the stores, where I don't consider general overheads. To get this figure, I take the sales revenue and deduct the variable cost. That is material cost, store operations, depreciation, and delivery expenses. To make it easier to play with the numbers later, I calculate this per store, and to keep it simple, I only take the total number of stores including partnership stores. The charm of this is that we can simulate economies of scale quite easily when the sales and margin growth from the increasing number of stores is hopefully paired with underproportional growth in overheads. The results here look also promising. The store level contribution margin has continuously increased over the past years and also the most recent quarters. So we have increasing number of stores, with each store on average making more and more sales and generating more and more profit. Let's go on so we can come to the bottom line. We have to take the absolute contribution margin from the store operation and deduct now the corporate overheads, sales and marketing, general administration, store pre-opening, asset impairment, and, in the past, cost from provisional liquidation and fraud. In absolute figures, we have seen quite some increase in the overhead cost. But if we look at it in percent of sales, we see constantly decreasing values here, which indicates realized economies of scale. So we started at 86% and over the years came down to 17.8%, and by quarter 2 2023 we were at 12.2%. In my analysis, I do not go further down in the quarterly reports and stop at the EBIT, so I do not include interest income payments, taxes, etc. here. I focus on the running business itself. And without surprise, the improving results from the store operation in combination with a reduced overhead and percent of sales lead to increasing profit margins. As of Q2 2023, Luckin is at 19% operating profit in percent of sales, which is pretty impressive. Let's now make the bridge from financial statements to the share price. Luckin had 253 million shares outstanding according to the reports, so in Q2 they made 4.6 Chinese yuan per share profit, which is annualized 18.5 Chinese yuan per share. Here I converted now to US dollar so I can compare it with the stock price in US dollar and also with Starbucks as a direct competitor. In US dollar this would be $2.5 per share. Annualized cash flow per share would be $1.2 US without going into detail here. Just important to understand that Luckin is already generating free cash flow. At the point of making this video, we had a share price of $33, which leads to a PE ratio of 13.1. Before we come to the final share price estimate, I ask you to please like the video and subscribe. I will give some updates on Luckin and some other growth stocks in this channel, but not spamming you with daily low quality videos or things like that. As I spent tens of hours to do the analysis and preparation for each video, I would be grateful if you spend 5 seconds to click the like and subscribe buttons. Now back to Luckin. Let's compare Luckin to the direct competitor Starbucks to get an idea about valuation. Starbucks had net earnings of $1 per share in their Q3 report, which ended in July. Annualized, this would be $4 per share, and With a current share price of $97, this is a price earnings ratio of 24.5. Considering the fast growth rates of Luckin, currently looks like much more than 50% growth in 2023 compared to 2022, I would put a P ratio of 40 for Luckin. My current personal target price would then be $100 per share, just considering the current business situation, not going further in the future. I am heavily invested in Luckin, and personally, I wouldn't even sell if we reach $100 tomorrow. I'll give some update about the current store growth in my next video and also about my long-term target price estimate for Luckin. If you have questions about my analysis, approach, or suggestions for other great solid growth stocks with proven business models, just write a comment and I'll be happy to reply. That's it for today. Please hit like and subscribe, and see you in the next video.